This is More Knowledge, More Wealth with your host, Gabriel Shahin. Gabriel is a certified financial planner and a registered investment advisor at Falcon Wealth Planning. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the services or securities discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. More knowledge, more wealth on AM 590, The Answer. Now here's your host, Gabriel Shahin.
Good afternoon. This is Gabriel Shahin, certified financial planner, and your host of More Knowledge, More Wealth here on every weekend, talking about all important topics of personal finance. Our goal is to give you the knowledge you need to increase your wealth. Now, to the listener, you can always reach out to myself or any one of our colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, where we can help relate the show to your specific situation. Now, I'm a principal of Falcon Wealth Planning. We are a fee-only financial planning firm. We manage money as well, but we specialize in comprehensive planning, folks. That goes over anything that involves a dollar sign. Whether that's where you are today, how retirement looks like, taxes, investments, estate planning, insurance, folks, you name it, we can help. And some of the bigger topics that we've been offering and talking about these days is real estate, which we'll talk about in this episode as well. But if you want help with this, we can help nationwide, folks. Give us a call. We'll offer a free financial assessment telling you what you should do, where you are today, and so on. Give us a call. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. We'd love to help you answer those questions that you may have. And lately, a lot of the call-ins that we're getting have been based on real estate, asking if it's a good time to buy. We have seen with interest rates rise, the natural occurrence that happens after that is real estate prices dropping naturally. A $500,000 house at 2.5% is different payment than if it's at a 5% loan. You get what I'm saying? The payments are more expensive. It's a few $100s more expensive. So the idea for you to understand is if your income is $5,000 or $10,000 a month and those payments are more, the bank is not going to approve you for that same $500,000. It might be $450,000. So naturally, real estate prices fall down when interest rates go up. So the question I always get is, does it make sense to invest in real estate right now? And I'm going to give you that answer right now. And it's extremely important because that answer dictates your diversified portfolio. It dictates what you should be doing. It dictates the outlook on real estate if you're holding it, whether you live in the home or it's an investment property for you. So the answer of what you should be doing in real estate, should you invest? The answer is very simple. The answer is, it depends. It does depend, guys. I'm sorry to say it, but it's true. It's common sense, right? If you have one property that's $500,000 after whether you get a loan on it or not, but let's say if $500,000 home is netting you $10,000 a year, that's a 2% return on that property. Hell, you can get a 3.5% 2-year treasury right now. Why would you waste your time with real estate if that's what your cash on cash return is? What does that mean? Well, if you rent it for $2,000 a month and your payments are $1,500 a month, including property tax, insurance, HOA, everything, then you are netting $500 a month. If you multiply that by 12 months, you're netting $6,000 a year. I know that's different than the $10,000 I said earlier, but that's how you have to think of it. Now, the other side of it is figuring out what's the down payment of what you're paying. Now, if you, in fact, put 20% down or 30% down, let's say that's $100,000. And let's say you're still netting $6,000 a year on $100,000 down. Folks, that's a 6% cash on cash return. You only had to put $100,000 down, and you now net $6,000 a year. $500 a month. Now, some people say, sign me up. That's great. And I agree with you. That's a 6% cash on cash. Let's throw some asterisks out there. That assumes there's no repairs. That assumes there's no vacancies. That assumes there's no out-of-pocket costs and anything with the property since then. So, yes, it's a 6%, but we know things happen. Now, by the way, folks, if you're just joining me, you're listening to Gabriel Shahin, certified financial planner and your host of More Knowledge, More Wealth here every weekend, talking about all important topics of personal finance. And today we are discussing the concept of investing in real estate. And here's how you determine if it's a good property or not. We talked about cash on cash return. Very simple. If you only had to put $100,000 down on a $500,000 home, that's what you measure your cash flow on from a cap rate point of view. And so when you look at netting $6,000 a month after all expenses and out of all the payments, if you have a mortgage on it, then you are getting 6% on your money. But that's not all of it, folks. The other part you have to look at is if your payment, in fact, is $1,500 a month, part of that payment pays down the principal. Now, if your payment includes property tax and insurance, your payment on your mortgage by itself might only be $1,200, which means maybe $400 a month is going towards principal. The other money, we'll call it $800, is going towards interest. So the benefit of this, you guys, is that you are paying down $400 a month off your mortgage. That's almost $5,000 a year that you are gaining in equity. That's in addition to the $6,000 cash on cash return. So where am I going with this? You are now making an additional 5%. It's not what you see in your money, your pocket, but it's what you see in the equity in your property. These are things that have to be looked at. It's something you'll tie it up in the walls of your home. You may not ever touch, but the point is that's how it works. Don't forget it. So if you're getting a 6% cash on cash return plus the 5% on the principal buy down, you're now at 11%. But there's more. Let's say now there is what's called write-offs, the depreciation on the property. It's a fake expense the government gives you. I mean, it's a legitimate expense. There's nothing illegal about it. I'm just saying it's truly a fake expense. And so you depreciate that property over 27 and a half years. If it's a commercial property, 39 and a half years. So on a $500,000 property, that might be $10,000 write-off a year. That offsets against your positive income on the property. So that's $6,000 a year you get, you might not have to pay taxes on it because you have this fake income that gets written off against that. Heck, it might be negative $4,000 is what you pay taxes on, which means you don't pay taxes on that rental income. Well, saving that write-off of $10,000, assuming that's what the depreciation is, well, that might save you roughly another $4,000 a year in taxes. So the tax benefit of depreciation, let alone writing things off like the property tax, like the interest, like the insurance and HOA or gardener or pool maintenance, whatever it may be, you get to write these off. So the tax benefit of maintaining that home could be crucial. And why is that important? Because that's an extra $4,000 in annual tax savings on your $100,000 down that you put on the property. That's an additional 4% cap rate. My goodness. Add that to the 6% cash on cash and the 5% principal buy down. You're at you're at 15%. Let's keep going, right? You having fun? Are you following me on all this, folks? Let's talk about the fact is that the properties also, over time, appreciate. Historically speaking, real estate appreciates. Let's just say it historically appreciates at a 3% rate of return. Okay? I mean, inflation is roughly 3%. I think it's even fair to say 4% historically. Hey, the past 2 years, it's gone up 25%. You get what I'm saying? But let's just say 4% for an average. If you add that on the appreciation side, guys, you're now at 19% return on real estate. This is why private equities were buying in left and right. Where 1 out of 5 homes in the states of Arizona and some of these other ones, Arizona for sure, were bought by institutions because they're running these numbers. So this affected the supply and demand. As interest rates go up, it's no longer as appealing to use leverage. By part of real estate investing and the benefit of it is the leverage of a mortgage. And when the interest rates go up, it doesn't make as much sense anymore. Another benefit of having a mortgage is over time, you already know this, what I'm about to say, you get to raise rents as time goes on, but your mortgage payment stays flat. So after 5, 10, 15 years, your cap rate's even higher than that. Why? Because that payment is still on your purchase price, and now you've already raised your rents 5 to 10 times in that 10-year period. So it's great to have a mortgage because your payment is locked. These are the characteristics and the things that you should look at when investing in real estate. I don't know if it's a good idea to invest in real estate now. It depends on the deal you get. That's the answer. And the deal goes two ways. Number one, what's the purchase price that you're paying for this thing? Are you getting a great deal on it? And number two, the terms of the loan. Is your bank offering you 7% or are they offering you 4%? Get what I'm saying? So it matters, folks, of what that looks like to make sure if it's a good idea to invest in real estate. There are some still good deals out there. There are some people in financial duress. There are people not doing as well as they were. Institutions are no longer getting involved at the mass they were prior in the mass purchasing they were doing. This could yield opportunity for you, especially if you're in a high tax bracket, especially if you own real estate, whether it's commercial, residential, whether it's commercial and you work out of there. Maybe you're the business owner that also works in there. There could be significant opportunity for you to take advantage of real estate right now, despite the interest rate. This could make a lot of sense for you financially. This is why we're recommending that you talk to a financial professional. We would love to help you. I'm not here telling you to go buy real estate. This is a financial show. The name of the show is More Knowledge, More Wealth. I'm just trying to get you knowledge. I personally think it's okay if people invest in real estate, but it's not liquid. It's not for everybody. Some people don't like the headache. Some people don't like the call at 2 a.m. that their toilet doesn't work. It's not for everybody. But if you want to have a conversation of just to see where you're at, what makes sense, what you're doing, and what's available to you, give us a call, folks. Our phone number is 855-963-2526. That's 855-96 Falcon, like the bird. We would love to help answer these questions for you. This is what we do on a daily basis, folks. Yet again, feel free to reach out. We're going to go on a quick little break, and we have more information on other types of write-offs you can have with real estate, especially if you have a large real estate portfolio or even if you have just a high tax situation. Stay with us. We'll be right back after a few words. Welcome back, folks. This is Gabriel Shahin, certified financial planner, and your host of More Knowledge, More Wealth here on every weekend talking about all important topics of personal finance. Today, I thought I'd pick on real estate and just see how it works, see what makes sense, understanding if real estate's a good investment. There is a lot of perks to real estate. I went over some of the tax benefits that you have with paying down your principal every month that the tenant, the renter, is doing on your behalf. You might get positive monthly cash flow. That adds to your cap rate. You might be getting depreciation write-off and other write-offs as well. The house also appreciates in value. And then lastly, it is locked. That payment is a locked principal and interest payment throughout the life of the loan, which is nice because that, with rents increasing, that can be very helpful. So I'm not telling you to go buy real estate, especially now with interest rates as high as it was, because the key is leverage with real estate. It's crazy, by the way, people don't leverage with their investment accounts. People leverage all the time with an asset and they call it investment as real estate, but how come you don't margin your investments? You have $1 million account. How come you don't take $500,000 out and put it also in the stock market? So you have $1.5 million in the stock market with only $1 million. Why? Because people consider that risky because they see the value of the portfolio on a daily basis. They don't always see that with the stock market or with the real estate market. I mean, some people think the Zillow price is their actual price of the home. No, it's a zestimate. It's not a full-on appraisal. And what is the value of your home? Whatever somebody's willing to pay for it. That's the actual value of your house. So, understanding that there are other benefits, the core benefits of real estate is taxes, massive, along with the good old leverage. So I'm just acknowledging those 2 points. What I'm saying to you is this. There are other ways to do tax benefits with a rental property, whether it's commercial or residential. And it has to do with something called, here's the fancy name, cost segregation. What the heck is that? It's an accelerated depreciation. Instead of writing it off over 27 and a half years or in 39 and a half years, there are additional write-offs that you can get early on depending on the structure of the property. Now, this is something you need a specialized accounting for. This is something that can't be done at your local CPA. You don't want to specialize in things like this because then you become a jack of all trades and a master of no trade. So this is something that could make sense, especially if you have, number one, high taxes, number two, a lot of real estate in your portfolio. The recommendation is to please consult with a tax advisor, but this can have and add substantial tax benefits to your normal personal tax returns or your partnership tax returns, whatever the real estate is held in. I see a lot of people missing this out, and there's a lot of people that do this. And hypothetically, you can go back 15 years to do a cost segregation study. That's what it's called. So you could do that. It's not uncommon to do that. It's just people get fearful of the unknown. There's a lot of extremely wealthy individuals and people with just one rental property that are not taking advantage of this. Most of the time, people realize this later when they start complaining about real estate. All I'm trying to tell you is this could save you time. This could save you money. Some people would rather get the write-offs today. Why? Because they'd rather get the money back from the government today versus stretched over 27 and a half years. Other people, you'd rather get the money today because you're in a higher tax bracket now. Maybe you're working in conjunction with the income. It could make a lot of sense for you to take advantage of that. I do recommend it for a lot of you guys, depending on your situation. But if you want to see if that makes sense for you guys, listen, we're a wealth management firm, wealth, not a money management firm. Listen, we manage money for our clients. I'm not trying to say we don't, but we specialize in comprehensive tax planning. You call now, we'll give you a complimentary tax assessment and we'll tell you what you should do. We'll explain it to you even better than that. This is why we grow so much off referrals. We recommend it. Give us a call, folks. We would love to help. Explain to you what we're talking about. Help relate this show to your situation. Our phone number, 855-963-2526. That's 855-96-FALCON, like the bird. Love to put together a free assessment to really answer those questions that you may have. You come in with the questions. We will be able to help you answer them. By the way, folks, if you're just joining us, you're listening to Gabriel Shahin, Certified Financial Planner, and your host of More Knowledge, More Wealth here every weekend, talking about all important topics of personal finance. Today, we thought we'd pick on real estate. We always talk about those dirty annuities that sometimes get sold your way, or insurance products, or some of these scammers out there trying to give you first trust deeds of a property that doesn't exist, or selling you gold and silver that's unregulated, and they're charging you unregulated commissions. And so we always talk about those. But real estate is a legitimate investment and does have room in a portfolio. And there are times it makes sense. There's also times you have way too much in real estate and you're so heavily loaded because you're just respectfully ignorant about how the stock market works. Our job is to explain to you what makes sense for you. And sometimes that matters with liquidity. Sometimes that matters of getting a monthly income that you can control, not what your tenant controls. Sometimes that matters on the tax strategic way of getting that money out. Because some of the cons of real estate is you can't just sell that property. You have to repay the taxes on everything you depreciated, everything that you wrote off. It's called depreciation recapture. And you still have to pay the capital gains on that as well. So you are stuck with real estate. We're not easily able to get your money out of it. So it can be very troublesome. It can be annoying. And that's why you see people sometimes in their 70s and 80s complain about their real estate. Kind of the joke in the industry is you spend the first 20, 30 years accumulating your money, gathering all this stuff, all this property, all these different accounts. And then you spend the next 20, 30 years of your wealthy years trying to simplify your life. I see a lot of people going from residential to triple net leases. My point is that you have to understand what works for you. What I'm saying on this broadcast may or may not apply to you. That is why we tell you to speak to a professional. And of course, there's us. We help people all across the country. We're more than happy to do that for you. My point is when you look at real estate as a whole, you have to isolate that specific situation. What is the estimated rent you can get for the property? Let's say you bought a place for $500,000, put 20% down. That's $100,000. Is there any additional spending you have to do to make that property subpar for somebody who can just move in? You might have to redo the floors. You might have to redo a bathroom. You might have to repaint the house. There are still things you may have to do. So if you have to put in $50,000 and only put $100,000 down, you really are all in $150,000. Folks, you have to calculate everything, including the closing costs. This will help determine if it's a good investment. Personally, I say if you can't get a 4% cash on cash return, assuming it's rented the whole year, 4% cash on cash return is probably not a good investment. Simple as that. I'll say it again. That means if you have a property for $500,000, you put $100,000 down, which means $400,000 on a note, on a mortgage. Let's just say your payment's $2,000 a month. You really have to get at least $2,350, that extra $350 a month. Why? Because over 12 months, it's $4,200. $4,200 plus that $100,000 down, assuming that the $100,000 included closing costs, assuming the $100,000 included if you had no upkeep or repairs to the house to make it rentable, that gets you a 4.2% return. You want at least 4%. Why? Because things are going to happen with that property. And it's not as passive income as you think. Passive income means you do nothing. There's times you do a lot. There's people who are retired who are not a realtor that are considered real estate professionals. And IRS acknowledges that you're spending a lot of hours on this and give you additional write-offs where you don't have limitations on how much you can write off. Now, those type of individuals can have a fantastic opportunity for cost segregation depending on their tax bracket. My point with all this, folks, is understanding your situation. What makes sense for you? I can't tell you what makes sense for you. Off this radio show, off this video cast, off this podcast, or whatever it is, but our team is able to help identify what you can do by understanding a little bit more about your situation. That's understanding what your tax situation looks like, understanding what your real estate situation looks like, understanding what your overall assets look like, what your cash flow is, what your retirement goals. These all play a part of if real estate is a good investment for you. People come up to me all the time and say, hey, should I buy rental properties? I don't know. Do you have $100 million in a bank or $100 in a bank? Are you working right now? What's your income situation? How stable is it right now? What's your stomach for volatility of people calling you in the middle of the night that something's broken? Is this property in California where you live, or is it in New Hampshire where you've never been? You get what I'm saying? So there are important concepts to this. And I know a lot of people say this is why you get a property manager. And that does make sense for some of you. I do agree, but they're taking 5 to 10% of the gross rent instantly. In that example before, if you're getting $2,350 a month, times that by 12 months, that's almost 27,000. They're getting $2,700 in rental management for that. Well, if you only made $3,500 or $4,200, they took majority of that money, which means you're not getting that 4% cap rate that we were talking about. Folks, these are the things that we do on a daily basis and we'd love to help you with. Give us a call. We can help see what makes sense for you. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, or visit our website at falconwealthplanning.com. That's falconwp.com for short. We can help put a free tax assessment for you at no cost. Truly helping relate this show, what we've been talking about, to your situation, folks. We can do that. We'd be happy to help. Man, that was a fast show. I want to thank you for tuning in with us this weekend. Please feel free to reach out to myself or any one of our colleagues here at Falcon Wealth Planning with any questions that you have. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, where we can help answer the questions as you have and relate the show to your situation. Call us. We'll have a free, confidential conversation to really help with all the questions you may have. Folks, we want you to enjoy your weekend. Have a great week, and God bless.